Good morning, everyone. We're just about to begin the broadcast here. Just a quick point of administration. If you have a question during today's seminar, you'll notice a raise hand button in your webinar console. Just raise your hand and we'll unmute your phones and you can ask your question live.
Great. Good morning. Thank you for attending. We have several owners in person here and a whole bunch more online listening in. What we want to do is respect the owner's confidentiality, and I guess that's why a lot of people have decided to attend online. The purpose of today is to generate some conversation, get owners thinking about the idea of selling or transitioning, recognizing that there's a lot of questions that they may not even be aware of, but they do need to start asking and looking for answers. I'm Eric Gilboord. I'm with the Warren BDC, and my co-presenter is Elisabeth Colson with Devry, and she'll do her own introduction in a second. But let me just tell you 2 seconds worth of what Warren BDC does. Warren Business Development Center is a company that works with owners to prepare the owner and the business for sale or transition. We work through operations, finance, sales, marketing, HR, and help them improve the value of the company. And so a lot of what we're going to talk about today is preparation of a business for sale. And the idea is that if you can increase the value of the business, then you can, in a perfect world, have a much better transition, a more profitable transition, an easier transition for yourself and your staff and your company and your family, and get to where you need to get to in a more pleasant, direct way.
Thanks, Eric, and welcome everybody. And for the people here in the room, welcome to Devry Smith Frank. Our firm has been around for 54 years. I'm an equity partner here, and I'm the head of the Corporate Commercial Law Department. And next month, I'll be celebrating my 12th anniversary with the firm. And that's really the longest I've been anywhere career-wise. I've lived and worked in Montreal, in Barbados, and here in Toronto, and I've held positions both in-house and in private practice. As of today, I have a very broad-based corporate commercial practice. I handle anything that has to do with financing, operating, and selling a business, with a particular focus on shareholder relationships and on mergers and acquisitions. And I really like what I do. I enjoy helping people make sense of things. I like turning ideas into concrete courses of action, and I like the challenge of variety in my days. For better or for worse, I'm kind of a den mother. I'm very client protective, and I'm a little bit of a control freak. The result is that I take my clients' issues to heart, and I become both emotionally and intellectually invested in them. And for that reason, it really just kills me when I see people not take the time or not have the knowledge to chart their course at the outset. Because in my experience, that just causes cleanup, wastes time, and ends up costing money in the end. You're going to hear lots of stories today about lots of people who have done things in different ways and different ways of sort of approaching the concept of transition, whether that means expansion or whether it means an actual exit or a passing of the torch while you stay on. But one thing I can tell you from a legal perspective, and I know it sounds a little bit silly, but it's actually the truth, but from a tax perspective as well, if you are thinking of an exit, you need to give yourself at least 2 years. So from that perspective, I'll let Eric sort of jump in with a couple of stories, and we'll take it back and forth. And please, everybody, feel free to interrupt. We're happy to take questions. Put us on the spot.
Yeah, I think we've called it a roundtable discussion for a reason, so We're going to encourage as many questions as we can. Our purpose, as I said, is to get the conversation started, and owners need to work on transition before they run out of time. And a couple of quick facts. 65% of established businesses in this country are owned by boomers. Boomers being anyone born between 1946 and 1964. And so the average age of a boomer owner is around 68 or 69 years old. It's not younger as some people might think. And, in my experience and in working with boomer owners of many, many established companies, I think what you find is that when you're 55, 60, early 60s, you're feeling pretty invincible. However, once you start getting into your mid to late 60s, you start to realize that you're going to basically starting to run out of time. That said, we're also getting a lot of inquiries from folks in their early 50s who realize what's going on in the marketplace and understand what's been happening with some of the older boomer owners, and they want to get ahead of the track and what's happening. So, there's two different kinds of audiences that we tend to talk to. It's the late 60s, maybe early 70s boomer owner, and it's the young 50s who want 10 or 15 years to get their house in order and figure out what they want to do. And Elisabeth, as you said, it's probably maybe from a legal perspective it's a couple of years, but from the standpoint of preparing the business, finding a buyer, doing all the things that are necessary to make it a really truly successful transition, it's going to take you 2, 3, 4, 5 years. Anywhere around that.
And Eric, I'm just going to it's interesting that you say that about the different ages. I also have a couple of clients who are highly entrepreneurial and quite young. The one I'm thinking of in particular is between 35 and 38. An incredibly successful person who started a business back in high school, and it transitioned incredibly well. And he sold the business and now has used the money from that to get into other things. And so from that perspective too, that's a different type of transition, getting out of the first business that he had established, exploring other options, finding new partners, and the same logic that goes into evaluating who you're moving forward with as you transition out and who is going to be your legacy. And to some extent, I think is also part of the thinking that goes into how do you expand and what new avenues do you pursue. So I agree 100% with you about the middle and sort of upper age ranges, but I've also seen a couple of exceptions in that lower range too.
Oh, absolutely. What's interesting about what you say is that the owners that I'm talking about, and our company tends to focus not completely, but it tends to typically go toward the boomer age. These are all folks that started these businesses 25, 30, 35, 40 years ago. They were basically the age that you're talking about. And some of them have gone on and done exactly what you said, which was they established a business, they sold it, they may have gotten into something else. Many of the owners, and maybe it's because of the culture and the times when that age group was growing up, they stuck with a particular business. And what's interesting is that some people are saying, well, okay, who's buying these companies? And what's happening is that if you've spent 20 or 30 or 40 years in business, running your own company, doing what you do, it takes a certain kind of individual to do that and to be successful. So while some owners may be selling the company and moving on, I think what they tend to find is that 6 months, a year, maybe 2 years, they start to get pretty restless. And so what's happening is that they're coming back and they're buying smaller companies, they're applying their experience, their skills, their contacts, in almost a mentory fashion to existing businesses, and then taking those to the new level. So there's a lot of age variation going on, and I can see owners, older owners, working with younger owners to help them get to the success that they deserve to have.
No, that's very true, and the sort of mentorship thing also I have seen exactly in the transitioning stage from the older owner. A client of mine was in a woodworking business and brought on some family members and very close family friends, and had a very long transitional period, about 10 years. He helped finance the buyout by the younger generation and was around for part of that on a consultative basis. And it worked incredibly well. It stayed very amicable. They did turn to him for advice. He knew enough and how not to strangle them, understood that, things going forward wouldn't be as they were under the old regime. And that worked incredibly well. So sometimes that mentorship is very good and practical. And sometimes it's not. I mean, I think it's up to the owner too to sort of think, well, can I be here without the decision-making authority and powers and challenges that I used to have watch somebody else while I'm still sort of in this nether world. And
well, yeah, and that's where you get into the stories about the owners that are in their 80s or even their 90s, and their children who had come into the business and helped grow the business are literally in their 50s, and the owner just still won't let go. So it's kind of the opposite can happen as well, and that becomes a real big danger, because you have people working in a business that in some cases they just want to get out. I mean, I often talk about the company, the owner who brought in their accountant's son and basically forced them to take over the business. And the first thing the son did was he did everything he could quickly to prepare the business and try and sell it. And because he never wanted to be there in the first place. And typically when I tell that story to owners, they will look at me and go, "Oh, I know somebody like that." And it's because most people do know someone like that. So if your plan is to sit back and let your kids take over the company and run it for you, we've met companies and owners like that in the past. And in one case we started working with the owner and the son and the daughter, and they each had separate responsibility for different departments. And if once you start working with somebody and you spend some time, and we're talking 6 months to a year, you begin to see what person is capable of doing it. And you see what they're capable initially, but you can actually justify your opinion once you start working with them. And there's no way that these kids were going to take over this company. Absolutely no way that they were going to run it. And that was the owner's plan. And subsequently, we actually backed away from the opportunity because we just didn't see success happening, and they weren't really listening to us.
I have a question
Sure.
related to this situation. I have a similar situation. I have a brother and me, and we're both expected by our father to take over the business that he has, and we honestly do not have much interest in that. So we're just wondering, how can we approach this situation?
Well, it's a really good question, and it's not an uncommon challenge. We sometimes work as a family therapist, and Elisabeth, I know you work from a mediation side of things, and so there is an opportunity here to bring someone from the outside in, really to help mediate the situation, because family dynamics tend to be the same in the business as they are at home. So if there's a certain dynamic where a parent or one of the children is stronger than the others in the conversation, then that's the way that business conversation is going to go. Bringing a third party in to just help facilitate, that dialogue, so that at the end of the discussion, the parent understands that you really, truly don't want to be involved, what the reasons are. And listen, you may have some reasons that you don't want to be involved that could be overcome. I mean, that's entirely possible. But, getting the dialogue going and getting it going in an environment where both sides of the dialogue are free to speak their mind and be honest and tell it like it absolutely is. But that would be my suggestion.
And in addition to that, which I agree, and I have brokered those types of conversations as well. Once the business owner realizes that that's not an option, he can start looking at what other options are out there. There can be perhaps an employee buyout. There can be employee incentive plans where you start to give some ownership over time, see how people adapt, see how they react, because people's personalities change as the expectations of them change as well, right? Someone may rise to a challenge that you didn't know about. And so I've seen that happen, and I've helped in that process, and have it has almost freed the owner up too, because now your dad, maybe there's someone else out there who would be a better fit, and he doesn't know because he feels whatever he feels protective towards his children. So it's often a good and healthy conversation for the kids, because you'll feel liberated, and for your dad, who may realize that there's options out there and how to approach them too. If somebody has always had that as a mindset and hasn't been exposed to the morass of what it means to leave, third-party help can help structure that, and that's a lot of what I do, right? I sort of guide them, explain the steps, help them with the paperwork, and it becomes a lot less frightening, especially when they have to do it. There's a little bit more motivation to look at those other options. So
And if I can just add to that, you know, within any business, there's always the blood family, and then there's the work family.
Yeah,
and the work family can be sometimes closer to the owner than the blood family, but I've seen very poor decisions made. There was a family business and that I've done some work with a long time ago, and there were three brothers that were, you know, in the scene, and one brother was truly not interested in the business, nor did he have the capability. The other brother, oddly enough, was a very successful lawyer, and so was not involved in the business. And so the middle brother was in that position where he pretty much demanded to take over the company. And this falls into the category of a sad story, but he basically took what the parents had grown over 30-odd years of a very successful business. And here's the key part: their total retirement plan was based on income from the business and possibly, you know, the son buying the business, you know, from them. And the middle son drove the business into the ground. I mean, literally drove it into the ground, and there was nothing left. And had it not been for the other successful lawyer's son, I don't know what would have happened to the parents, you know, in terms of their retirement. It was just a horrible occasion. What happens sometimes is, and we've seen it happen more often than I like to think, an owner will promote or put a blood relative into a position of authority because they almost think that they have to do that. And, you know, you could, as Elisabeth said, you could conceivably have someone working in the company already who's way more suited to run the company and could make it, you know, significantly more successful. And, you know, having worked with lots of different owners that have gone either way, there are many, many positive cases where an owner and the children have agreed to step back, and an owner has, you know, basically anointed someone else to run the business, and it's to everyone's benefit. Everyone gained from the experience. The business, you know, continued to grow and continued to be successful.
Yeah, and I've seen a lot of that. I mean, I've done an awful lot of employee incentive plans and management buyouts and all that kind of stuff from inside. And it usually works quite well because you're dealing with people who already know the business, who are familiar with the business, who have an interest in it, and who have themselves devoted a large portion of their working lives to it. And it can be a very much more seamless transition than one would think at the outset.
Okay, I'm going to just take 2 seconds and read a typical email, the kind of emails that we get at Warren BDC, and here goes. I'm in the very early stages of planning a transition out of my current business. So some of you may be able to relate to that. Still considering a few options ranging from keeping the business and remaining actively involved in the management to developing a general manager and stepping away from the day-to-day operation to outright selling the business. Not sure how to best proceed. Do you have any suggestions? Thanks. And I guess that, you know, the first thing is it's a great idea to explore the varying options that you might have available to you. What I find with many owners is they tend to believe it's a black or white, you know, world out there. And it's like, geez, I'm going to stay or I'm going to sell. I'm going to stay or I'm going to sell. And I don't really know, you know, what my choices are. But the reality is that there's an extremely broad gray landscape, which means that you could do a partial sale, you could bring in a partner on an earn-out basis, you could do so many different things. You can stay involved in the business, as we've been talking earlier. You can bring in family, you can move up, you know, existing employees. One of the key things that I want to leave the audience with today is that it is a very, very gray landscape. There are so many different ways that you can go, and you owe it to yourself to explore as many different options as you can, and to get started as early as you can in exploring the options.
Yeah, and that's very true, Eric. There's one client of mine had a business with several standalone divisions, and when we first met him, he just wanted to sell the whole thing wholesale and had gone very far down the road. He had a letter of intent. He'd hired tax counsel, and then was introduced to us. and was able to sort of see a little bit of a different perspective on what he wanted to do. And he actually put the whole thing on hold for about 18 to 24 months and landed up deciding instead to sell it off division by division. And I mean, he's a perfect case study, actually, because he also has children working in the business. And over time, he was able to cherry pick who he wanted to sell those different divisions to, where he wanted to use his children so that they could continue to run certain of the divisions he's still holding on to. So his entire exit strategy and plan changed drastically from what he had first imagined because he saw the different options available.
We had an occasion with a company, a very large company in the $35 million annual sales range, and we had conversation with the owner and agreed that we were originally brought in because the owner wanted us to look at acquisitions as a form of expanding the business, and that's yet another way to go. It isn't always necessarily about sales and marketing, that kind of thing. You can grow exponentially through acquisition. So we came in and we looked at the business and had a very frank conversation, and we all agreed that it would be in his best interest, based on health and a number of other issues, based on the age of the up-and-coming management, who were probably 10 years away from managing a $35 or $40 million company. There was this gap here between what their skill set was and what was required. So we agreed that we would, find a buyer for him, and we did, and we found a buyer, and through 6 months of full due diligence, letters of intent, and all the necessary processes, we were in a position where we were literally 5 days away. All I's were dotted, all T's were crossed. We were 5 days away from selling 70% of the company for $28 million, and the owner would keep 30%, because if the new owners came in and did what they said they were going to do, and we believed they would, then his 30% would probably be exponentially worth more than the original 70%. 5 days before, he called off the deal. So if I was standing here with a check for $28 million and I was about to hand you that check, how inclined do you think you would be to walk away from it? And he had his own reasons, and it's not uncommon that an owner can be a runaway bride because they decide that they are not necessarily ready to move on, and that happens all the time. So the moral of the story is being true to yourself and really truly understanding what's going on inside your own head. And, as we've been saying all along, is talking it out with various resources, because what you're about to do is make a huge, significant decision. And for the most part, this is probably the single biggest sale or biggest decision that an owner is ever going to make, and it's probably the one that they're the least qualified for.
And that's, I've seen it oftentimes from the purchaser side, what you're describing, and I've, two clients come to mind immediately, one of whom was a very, very senior executive in a company, found a business in a very similar niche that he was interested in purchasing, and had great conversations with the owner all the way down the road, signed a letter of intent without the benefit of counsel, so that is a plug for a lawyer, but so what? And the letter of intent was really vague. When it came time to actually formulating the agreement, he began to realize that the owner had certain preconceived notions about the type of security that he would be able to take over an outstanding balance of the purchase price. I became involved, tried to negotiate the agreements. I was working with the purchaser's bank, trying to get the financing in line, trying to do anything we could to pull things together. And ultimately, what revealed itself was that the owner hadn't been very transparent, had an awful lot of debt that he had been kind of hiding, hoping that he could put something over on my client. Because of my client's enthusiasm for this, he was just all over the place with it. And so it's a matter also of knowing yourself, knowing when to walk away, which my client ultimately did, but also knowing what you're getting into, and having the advantage of time and planning helps you be much more sensitized to that. It's not just a matter of, this is a cool guy and we had a great time together when we shared a beer and we're on the same page. It's a lot more, and you need to understand the business, the hidden pieces, the ups, the downs, what type of personality that you're dealing with, because especially if you have any sort of vendor take-back going on there, you're going to have a relationship for as long as that indebtedness exists. And you need to be able to, even if you're buy from someone with whom you can work, because you may find yourself in bed with that person for a lot longer than you think.
Absolutely, and you know, words of the wise, and I've had many conversations with folks who are at the early stages of talking to our company, and they've inevitably said, well, we have a letter of credit. Well, I'd like to assure you that having a letter of intent, having a letter of intent is not a deal.
No, it's not.
And you're far, far away from having a deal. And oftentimes people are running around going, oh, we're covered. We have somebody, we got it, I mean, we've heard this as well. We got a call from someone in the States and they're interested in our company. That's not a deal.
No.
You're way, way far away from that. And if you think that you can just, you know, establish, you know, the sale of your business based on one or two or three people that are, you know, pose some interest in your business, you're kidding yourself. That's just not the real world.
And I had one exactly. This client of mine got a call from someone in the States to purchase his business here. They, again, signed a letter of intent. And then as the deal went on, as we tried to negotiate it and frame it into an actual agreement, the purchaser began chipping away and chipping away and chipping away at what he was willing to pay. He needed to be financed over time and offered at some absurd point in time to provide us with security over a building located somewhere in upstate in one of the northern states. And it became patently ridiculous that there was no substance here for all his talk about how prolifically successful he was. So it's a letter of intent. They're typically non-binding, and they should be, with the exception of certain clauses, etc. But that's a little bit more granular detail. It's not an agreement. It's a starting point to make sure you're both on the same page, which is fantastic, and it's an opportunity to flesh out what you both want. And then you have to take it from there. It is not a done deal at all.
And on the other side, in terms of the owner misrepresenting their business, or the owner saying, well, you know, we don't have to tell them this, or they're hiding some financial information.
It's going to come out.
My answer is very simple. If you really think that somebody who's capable of writing a $3 or $4 or $5 or $10 million check for your business isn't going to see through those things, then you're kidding yourself.
Yeah.
And you're the one who's going to end up losing. So while the purchaser side may not be serious or may not be qualified to do things, the owner side can equally be operating from a perspective that's not necessarily serious or ready to go.
No, then that's very true. You know, and there's lots of, and that's fine too, right? I don't look with aspersion, or I don't cast aspersions on people like in that situation. I think it's also a matter of testing the water, seeing what they're willing to do, seeing the extent of what is required of them as sellers, and the due diligence, if you're selling the shares in your business, is tremendous, because you have to be completely transparent. Someone wants to know the nuts and bolts. They want to know everything, and it's really, really can be daunting. But it also, you know, I've seen that sort of thinking too sometimes in people who say, well, I want to give my employees an option plan. I want to have my employees as, you know, phantom shareholders or whatever it is. And then they go back and forth on that as the thinking process evolves. And I think that's all part of the process of the transition itself.
Yeah, I think that in some cases they don't know what they don't know.
Exactly.
And again, they need to speak to someone like yourself. There's a lot of misinformation about, you know, shares and shareholders and whatnot. But there's another story that I would like to tell. It's a $13-14 million company in the recycling business, and two owners had been together for 30 plus years. And it was a kind of partner relationship that you would imagine, where they're at each other's family functions, and the kids call the other uncle, you know, so-and-so. And what had happened is that one of the owners had been trying for the last 3 or 4 years to get his partner to talk about, never mind moving forward with selling the business, but just to talk about doing things. And he kept delaying it and putting it off. And interestingly enough, while they've been very successful, and not only they own the business together, they own buildings and real estate and whatnot, as you can imagine, there was a very, very tangled web of ownership that would take quite a while to undo. The one partner who really didn't want to talk about things, interestingly enough, they did not have a shareholders agreement. They had a half-written shotgun clause, which is maybe something you can chat about, that other people, you know, think that they can have. And it got to the point where they were not speaking to each other. So you take a 30-plus year personal and business relationship and you destroy that over, you know, something that was totally unnecessary. Long story short, you know, one of the owners decided to actually buy out the other owner, and they're slowly repairing that personal relationship. But it was unfortunate that they had to go through that exercise. And part of the reason that they went through that whole exercise is because they tried to do this on their own. They actually thought that they would conduct the discussion and the negotiation and any legals and financials and all that on their own. And it's just a very, very poor decision. I've never heard of a situation where that worked out. I find that oftentimes when people are into that kind of a dialogue, and it could be with the next generation of children, it could be a partner, it could be a lot of different, could be with a divorced spouse. You know, as soon as you go down that path and you believe that this is going to be relatively easy to go through, all of a sudden someone will whisper in the other person's ear, and that's where the trouble starts. And so, you know, getting the proper advice and the proper representation for both sides are absolutely key.
I have a question.
Sure.
Thank you.
When the management is assuming that the management takeover buyout is the plan,
Mm-hmm.
how will they react to one shopping for the buyer outright? It's kind of a conflict of interest. The management wants to buy it, but
It typically happens in quiet.
you cannot keep it confidential when you're shopping for the buyer because people need to come to the compound and see the warehouse.
There's lots of ways around that. I mean, first of all, you're going to have conversations that are probably outside of the office. If that is what you're thinking, and I agree that shopping makes a lot of sense because you're just increasing your knowledge in terms of your options of what's out there. Oftentimes, someone can come perhaps from an outside buyer, and you're going to tour them around. They could be a customer, they could be a supplier, they could be anyone. You don't necessarily announce that this is somebody that we're talking to about buying the company. So it's done discreetly, very discreetly. There's a lot more activity in the world of outside purchasers than there is from inside management takeovers.
But I also think and I agree wholeheartedly with what Eric is saying. It's true. The owner, unless the owner has committed to the management buyout, has the opportunity to explore options. But oftentimes, key employees who would typically be part of the management are made aware of what the owner is thinking. And if it's going to be a management buyout, then the group of managers or employees that are going to be involved in that have probably initiated discussions themselves, may have presented an offer, may have approached the owner with their thoughts. And so the owner may, and I'm a very big advocate of being honest and forthright, the owner may think it even in his best interest to say, look, guys, this is what you're offering me, but Mr. X over here might be able to offer me something more. I'd love to give the business to you because you've worked in it and you understand it, and I think it'll be better for the future of the business, but it's my retirement we're talking about here. How can we come to terms? And I think if you can finesse that properly, have help strategically planning those conversations, you can navigate that without being in a conflict of interest, except of course if you have signed off on something with the management team, then it's a little bit of a different situation.
And I agree with you completely. There's discretion and there's honesty, and both things are equally important. So in terms of bringing people in to look around, you don't necessarily want the bulk of your employees to be seeing that, because people, if they don't understand the whole story or they don't even hear the story, they will invent their own story. When it comes to very key senior management, absolutely you need to have them involved in those conversations. It's probably one of the first things a buyer is going to want to do,
they're going to want to
is talk to the absolute top key individuals. So no, you're not going to keep it a secret from them. You're going to engage them in the whole conversation.
Because often those people are key to the continuity of the business, and the purchaser is interested in keeping them on, wants to meet them, right?
Sure. Another question.
Sure.
When you sell to management, you can dictate higher price because you're financing the deal. When you're selling to the buyer, they're buying for cash, I assume, more or less.
Well, you're not always financing the deal with the management.
So what's the difference in the price, let's say, multiplier of EBITDA when you sell to management or you sell to the outright buyer?
I think Eric's point is quite valid. It really depends on whether or not you're financing it to one or the other, and you might also do a vendor take back whereby you do finance part of the purchase price to the buyer. So it really depends on what the offer is, the type of payout that you're looking at, the type of security that you may be able to get, how much you feel that the purchaser, whether it's the management or the third party, will be able to sustain the business, understands it, carries it forward. So to do it as a function of EBITDA is a little tough because the premise of the financing is very fluid when you're negotiating at that point. I mean, there's tons of formulas. Typically, it's about 3 times EBITDA averaged over the past 2 to 3 years, right? A multiple 3, 4, 5 times. But it can really depend on what the past 3, 4 years has been, what your prospective plans are, what your current debt is. Did you recently buy a huge piece of equipment? There's a lot of stuff in there.
Yeah, and I think it's fair to say it, because I believe your question, the core of the question is the difference between selling to the management versus selling to an outside resource. And I would suggest that the average owner is typically looking to maximize what they can get out of the business. So I don't think that they are generally looking to favor the management by giving them a better deal. When it comes down to it, you want what you want, and you want as much as you can. The other point is that while the management may possibly, put their own money on the table, or maybe, as you said, a vendor take back, management can go to the bank, management can go to private investors. There's lots of different places where the management can come. In our experience, in a management kind of a purchase, the management themselves typically don't have funds, and that's usually where these things fall down, is because they're, while they have great intention, and they have great experience and all that, they don't necessarily have the funding, so they typically have to go outside, or, as we said, it might be a vendor take-back kind of scenario. It's a time, 2018, where in some cases with owners, if you would have asked them 5 or 10 years ago, do they think they're going to have enough funds for their retirement, or, to enjoy the balance of their life, they might have said to you, yeah, we're okay, everything's on track. I think what we're finding in the last little while is that owners are starting to be very concerned. And we're talking about people with significant wealth who are also, being very, very concerned about what's going on and what's going to happen, and truly wanting to maximize what they can get out of the business. There's not a lot of people that are looking to give things away.
I'm going to go back to the shareholder agreement that you mentioned before, and the importance of that when you do have partners. I'm not a very big proponent of over-papering things and sort of getting into overly complex documents, and a shareholder agreement really can be quite complex. So in the beginning, when everything's going well, if the structure seems to indicate that one would be helpful, it should touch on the usual stuff: governance, exit strategies, valuation, and how do you say goodbye and how do you get rid of each other. The worst thing you can do, I think, is to have one that's deficient, which goes to your point about kind of a half-written shotgun clause, which is where one shareholder says to the other, I'm willing to offer you X for each of your shares. Either you pay me that price, or I will buy your shares for that price. So that's typically how that works. And I had one instance where there were two family members, and they had a very poorly drafted shareholder agreement, didn't have things about how to value the business or even how to exit. And one of them tried to get out, and their family relationship, similar to what you were describing about your partners, it deteriorated. One of them sat in our office virtually in tears. They didn't speak. They got lawyers involved, and it was an absolute horror show. So it's one of those things, a shareholder agreement, that can be very important, but I think it's also important to determine whether or not it is really necessary, because it can also get quite costly. So it's also something that doesn't have to be done at the outset, right? You can do it as the business evolves. For example, in the case of a management buyout, the new management might want a shareholders agreement where the initial owner and his wife didn't feel that one was necessary, right? So that it can come in at any point in time in the process.
Why is it costly?
Because it's not an easy document to write. You have to get the deal points of both parties. You have to get where their areas of concern are, the ifs or buts, right? And how to figure out, there are so many that are so case specific for the business. And the more that becomes involved, oftentimes the other parties are going to want to review it, have a lawyer review it, so it can be negotiated. There's revisions, there's discussions, and it can start to add up, just purely a function of time. I don't really believe in flat feeing something like that, to be blunt, because it is so unpredictable. I believe more in telling people this is my estimate. As we move along, I'll let you know how we're doing in terms of that estimate. Do you want me to scale back and you move it forward if we're reaching a point where financially it's becoming something that would lose interest? I work with my clients that way, but it is not a simple agreement. It's not a form that you download. It's really, really tailored to the business, because sometimes there's things in the business itself that dictate specific terms. Let's say one person has shares that might vest over time. That has to be treated differently. If there are shares with different voting powers, if shareholders can buy each other out under different circumstances, that's where it's important to clearly set that out, so that while everybody's getting along well, it's a lot easier to come to agreement. When things sour, or when one of these events comes to pass, you want to have something clear that everyone goes, oh yeah, here it is. And when things come to pass, you don't want to live by the shareholders agreement. As long as the parties consent to doing something other than what's in there, that's totally fine. But to have the framework, that's what you kind of want to rely on.
I have another question. With regards to employee incentive plans that you discussed,
yes,
is it a good idea to make the employees rich in the process and then sell to them when they become wealthier and they can finance themselves? Or they can arrange the financing?
Depends. It depends how you are impacted by, quote, making them rich in the process, right? If you give them high dividends, that's one thing. Then they may be able to finance it themselves. Or you could give them nominal dividends, bank those dividends for them rather than give it to them to spend, and then they have that pool of money, and then they have to get additional financing. I think it's difficult to say better, because it depends a little bit on the business, on the nature of the people, on the ultimate purchase price. There's options to explore, and the way I typically handle that with my clients is to sort of say, like, okay, explain to me what your objectives are, explain to me who the players are, explain to me what your history is, and I ask a lot of really, really sort of rude questions that I wouldn't want to answer in order to be able to figure out how to help someone say, okay, these are the two options I would distill down for you. How would you like to proceed? And it's, at a given point, it becomes a business decision, right? It does vest in the owner at the end.
Let's shift the conversation a little bit away from the financial side of things, and let's talk a little bit about preparing the business for sale and why one should really start thinking about that. And basically there's really three key reasons why owners aren't necessarily planning to grow pre-transition. I mean, they've basically been, operating on cruise control for the last number of years. And the three reasons typically tend to be: one, fear of losing control. So owners will likely, and in our experience, grow a company to a certain size that they feel comfortable wrapping their arms around. They feel like they can manage everything. Everything is somewhat in their control. And by control, I don't mean that they're looking at every little thing that happens in the company. They may have a general manager, they have other management folks, but they feel like this is the size, they don't want to take it anymore, because as soon as they take it to the next level, so if you're 2.6 and you start to hit 3 or a little over 3, there's a different set of skills that are required. There's a different set of responsibilities. There's sometimes more people. 5 million is the next level, 10 million, 20 million. So whenever you are approaching that threshold, you start to typically pull back a little bit, because there's a lot of things that perhaps you don't want to deal with. You're comfortable with what's happening. Another reason is, when you sit down with someone and you say, well, gee, you could sell, 3 more of these $1 million widgets that you've created, and they look at you and they say, well, when I ask the question, why don't you want to, sell more? The answer sometimes comes back as, well, I know I could sell more, but I can't finance it. So, a lack of capital and a lack of knowing where to go for capital. The banks are one resource. Private money is another resource, factoring is another resource, but you may or may not have had appropriate experience in those areas, or you may not have explored them. But what I find interesting is when companies have the ability to grow 2 or even 3 times because the business is out there, and the thing that's holding them back is they can't necessarily finance the project. So they can't necessarily finance the raw materials. They can't finance the invoicing of that particular project. The third thing is finding the right people. So, yes, I know I can get more business, but I don't have the money and I can't find the right people. And there are very, very good resources out there for finding the right people. I mean, we're doing that with the client right now. They're highly specialized in the business that they're in, and they're currently working in one particular industry. And what has happened in the last little while is that we've found them a new bank relationship. We have found them a resource to find the right people. And one of the interesting things that came out of finding some of the right people is that one of the folks that is potentially going to be hired has the ability to be a general manager, which would therefore allow this client to sit back and do the things that he's really good at. And what he's really good at is solving difficult problems within the confines of his specialty. He's just very, very experienced and very good at what he does. And he's a pretty good sales guy. And in a perfect world, when you ask someone like that, how would you like to spend your time? I mean, if you didn't have to do all the things that you don't want to do, you had other people doing admin and bookkeeping was in order and everything was in place, what would you want to do? And typically, it's in this case, it's solving very difficult problems, and it's also being at a point where he's just doing sales. So one of the things that came out with his general manager potential is he comes from a completely different industry. It's an industry that our client had been looking at, but a completely different industry. And the individual is a plant manager and in a large plant. And at that point, we could do a very quick download from this new person of that industry and effectively go after an opportunity that's equal or even greater than the opportunities that our client has been going after currently. So, you know, in terms of the abilities that one has to increase the value of the business, it typically starts with dealing with what's going on inside the mind or the mindset of the owner. And typically the owner is the one who's standing in the way. Sometimes we're sitting with owners and we'll say to them, you know, and we talked about EBITDA a little bit before, and I don't want to get into a deep conversation about that, but, you know, typically when you're selling a business that's perhaps under $10 million in annual sales, you're probably looking at, you know, 3 or 4 times EBITDA. And typically, not all the time, but typically, if you're selling a company that's over $10 million in sales, you may be looking at 6 or 7 times EBITDA. So you're looking at a more valuable business, a better EBITDA, and a higher times rate. And why is that? It's because while people will buy companies under 10, I'm not going to pretend that they won't, there are enough buyers out there who are looking for companies that are over 10 million in annual sales. I mean, well run, good cash flow, good people, management, all those things. But, you know, there's a reason why you want to take a $6.7 million company, you know, or even a $9.2 million company and get that over 10. And when we have that conversation with the owners, inevitably what happens is that the owner will look at you and say, oh, okay, I get that. I can get the company over 10 really quickly because they've been what we've been talking about. They've been sitting on opportunities. There have been things on the back burner, or they have not gone out more aggressively from a sales and marketing perspective. And it's interesting that, you know, you are, as an owner of a successful, well-run, smaller, medium-sized company in the $3, $5, $10, $20 million range, you're likely sitting on a gold mine, and the analogy is it's like having a Ferrari in the Ferrari in the garage and taking it out for milk. You know, there's a lot more that you could be doing of what you're doing, and you know, in our organization, it's something that we like to focus on tremendously, is to get owners to take advantage of all the 20 or 30 or 40 years of hard work that they put into that business and to start maximizing it before they sell.
And it's a good point, Eric, that you mentioned about bringing on new staff too, because going back to the 2-year time frame that I mentioned at the outset, part of that is sort of organizing the business, getting it so that if a buyer comes and takes a look at it, things are clear. You have your people who can help direct them to the information, you know, different streams of information that the purchaser will want. And oftentimes, putting into place a senior management role frees up the owner to be able to seek new opportunities, to prepare the business for sale, know that it's being run effectively, and gives the purchaser a feeling that there is going to be somebody there for the transition afterwards. So the new staffing piece is important, as you're describing, because it can bring new opportunities, but it can also make the business itself much more sellable, even if those new opportunities don't come to the fore.
And there's another, thank you, and there's another part to that. I had a conversation with someone who owned call it a $2.6, $2.7 million business. So they fit into that category of not necessarily wanting to put out the effort to grow the business. It was a millwork company, and he'd been in business for 25 years and done some specialty work, in fact, with restaurants and some beautiful work. When I looked at his website, it was like some gorgeous, gorgeous carving and whatnot. And he decided, he had about 20 employees, and what he decided was that he did not want to put out the effort to grow the business. So, you know, we left it as, okay, you're not ready right now, we'll, you know, talk sometime in the future. And in the interim, I had someone who needed some work done. He needed some mill work done, so I sent him to visit this gentleman. And so, you know, a couple of days later, I get a phone call, and it's like, hey, Eric, what are you doing? I said, well, what do you mean, what am I doing? He said, well, I went to visit the gentleman that you told me to go to help me get out of my emergency millwork challenge. And you told me he had a 20,000-foot facility, and he had 20 people, and you know, I get there, and there's this gentleman sitting there by himself, and a 3,000 square foot facility. He didn't have the equipment, he didn't have all the things that he'd had a year or two prior. So what happened? Like many companies, he had essentially 20% of his customers doing 80% of the business. In his case, they were actually two customers. They were retail chains. And one left, and then the other left. There was no business left after that. So, you know, if he had heeded what I said, and I'm not suggesting that he had to do business with us, he could have done it with a lot of people, he would have taken some steps to, A, grow the business, but B, make sure the business was more desirable to a buyer. Because when a buyer comes in and sees that, you know, 20% of your customers are 80% of your business, that's pretty risky. And unless you can add more, you know, good customers into the mix, that's going to make them stop a little bit. Or even if they decide, because they're smart business people, that they can get way past that very quickly, they're not going to pay you what you think your company might be worth, because there are some drawbacks. And it goes with not having your systems documented, not having the right people in place. I've rarely walked into a business, and it's typically in the lower end of small and medium-sized business, say, you know, 5 and under, where during the tour, the owner takes me around and inevitably introduces the bookkeeper as an accountant who's not really an accountant, who's not really a bookkeeper, who's their sister-in-law, who's dealing with a 1987 version of QuickBooks. And you know, these are the things that when someone is walking through your facility and thinking about making an offer for your business, where they're going to look at it and say, well, maybe this isn't exactly what we want, or maybe it's not worth what we're looking for.
And on the client piece too, I mean, I've worked on transactions where people have said, okay, you have to guarantee me that this client is going to stay with me for at least, pick a number, 1 year, 2 years, failing which I'm going to claw back some of my purchase price. And that's not unusual, and it's really not unreasonable either. And so that the client base is a very important piece, as is the internal organization. How are we doing for time?
Yes? Well, I speak with a lot of old-timers, and they always give me the same advice. Keep your business for 3 years. You get basically the same money as if you sell now, and then keep for another 3 years. The company is for free, whether they go bankrupt or close. It really doesn't matter.
Can I comment on that?
But that's a common advice you get from people that are old-timers, I mean, 80 plus. And they're good.
Yeah, because they don't have the runway. I mean, what we talked about earlier was taking your business and making it worth more. So, yeah, sure, you could do that. In fact, there are some folks, typically on the lower end, the kind of under 2 million size of company, who their exit strategy is, I'm going to suck out as much cash as I can out of the business for the very reason that you said, because I don't think that I can, you know, I want to spend the time or the energy on it, and I'll just close the doors. And, you know, what people need to understand is that, you know, whether it's a 2 or 3 or, you know, $4 million company, typically there's probably a minimum of 20 employees. So while that's a wonderful plan for the owner, that's a horrible plan for the employees. And most of the owners that we've ever dealt with or even spoken to, they have a sense of obligation to their employees, and you know, they have a sense of responsibility. And I think that it's fair to say that the economy, I mean, we're not talking about one person, one owner doing this. What if 100 owners did it? What if 1,000 owners did it? What if 10,000 owners did this, and each of them put 20 families at risk for doing that, when in fact they, A, don't have to do that, because it's a horrible decision for our society and our economy and our culture. It's also a horrible decision for themselves, because the real world is, if you know you can make X amount of dollars by, you know, just taking your regular profits over 3 years, and your plan is to close the doors, at least explore the opportunity to do more with it. That's our advice.
I just want to do a time check, because I think people were gracious enough to join us for an hour, but we might be hitting close to that.
It's 8:58.
8:58. God, I'm good. Okay. So then, on that note, maybe I'll just thank everybody for attending. Those that are here in person, it was great to see you and to meet you. And those online, we hope that this was at least interesting and hopefully helpful to you. Eric and I are available for any questions, any offline conversations, anything like that. You know, we do enjoy helping people. We do want to get people sort of successful, and we want to get people thinking of us. And so if there's anything that either of us can do for you, please don't hesitate to reach out. And Eric, any parting words?
Yeah, I'd like to say that this is the first roundtable discussion that we've done together, and to me it's been a terrific experience, and I hope that we've provided some valuable insights and things for owners to think about. There will be more discussions, and the discussions will be different. And the whole purpose behind this is, as we have more people come and participate and more people ask questions, we're going to allow those questions to take the conversation where it needs to go. And so if you've listened in today, we thank you very much. We'd encourage you to listen in again. We'd encourage you to let your fellow business owners or trusted advisors know that we're doing these things again, and it's become a regular series.
Agreed.
And if you have any suggestions at all in terms of topics, we'd love to hear from you.
Yeah, please.
So thank you again for the folks who came to our live portion, and to all those who were listening back at the office, or some say back at their house. We don't know for sure. Thank you very much.
Have a great day. Thank you.
Can we maybe go around and speak what our main issues are?
Sure, we can shut it down.
Yeah, absolutely.